Hello, and welcome back to Boni's Life, your home for deep dives into the forces shaping our world. Today, we're tackling a topic that's not just knocking on the door of the financial world, it's kicking it down. We're talking about the artificial intelligence revolution in trading and investing. Forget what you think you know about Wall Street. The age of the lone wolf trader, running on gut feelings and a pot of strong coffee, is rapidly coming to an end. The new king of the financial jungle is intelligent, lightning fast, and it never sleeps. It's AI. We're going to explore how advanced AI models, like the much anticipated GPT-5 from OpenAI and its rivals from Anthropic and others, are fundamentally rewriting the rules of the game. We'll hear from the titans of finance, the billionaires, the legendary investors, the biggest institutions on the planet, and see how they are scrambling to adapt to this new reality. We'll also look at what the regulators are doing to keep this powerful technology from running wild. And of course, we'll bring it all back to you, whether you're a seasoned trader or just starting to dip your toes in the market. How can you navigate this new world? Is the rise of the machines a threat or the greatest opportunity of our lifetime? But first, let's get a snapshot of the market as it stands today, November 19th, 2025. The global crypto market cap is hovering around a staggering $3.2 trillion. Bitcoin, the reigning monarch, is trading at about $91,000, with a market dominance of nearly 57%. But the real story is the volatility. The fear and greed index is flashing extreme fear at a value of 16. We've seen massive liquidations in the last 24 hours to the tune of over $273 million. It's a jungle out there. And in this jungle, the apex predator is getting a major upgrade. So buckle up, this is not just another tech trend, this is a seismic shift. And by the end of this episode, you'll understand why. Let's get into it. To understand where we're going, we need to understand where we've been. For centuries, trading was a very human affair. Think of the chaotic trading pits of the Chicago Mercantile Exchange, with traders shouting, gesturing, and making deals in a flurry of organized chaos. Then came the digital revolution. The pits emptied out, replaced by the silent hum of servers. Algorithmic trading, or algo trading, took over. Computers were programmed to execute trades based on a set of predefined rules, at speeds no human could match. For a while, that was the cutting edge. But even those algorithms were, in a sense, dumb. They followed instructions. They didn't learn. They didn't adapt. They couldn't read the news, understand the nuances of a CEO's speech, or gauge the sentiment of millions of traders on social media. That's where the new generation of AI comes in. Models like GPT-5 are not just following rules, they are learning. They are large language models, or LLMs, which means they can understand and process human language and vast amounts of it in the blink of an eye. Imagine an analyst who has read every financial report, every news article, every tweet, every research paper, and every book on economics and finance ever written, and not just read them, but understood them, and can recall any piece of information instantly. That's what these AI models are. They can analyze a company's earnings call transcript and detect subtle changes in the CEO's tone of voice that might signal a lack of confidence. They can scan satellite imagery to count the number of cars in a Walmart parking lot to predict retail sales. They are the ultimate research assistants, and they are rapidly becoming the ultimate traders. Don't just take my word for it. Let's hear from the people who manage trillions of dollars. Let's start with a living legend, Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates. Dalio is not just some old-school investor reluctantly embracing technology. He's been a pioneer in algorithmic trading for decades, and his predictions about AI are frankly chilling for anyone who thinks they can outsmart the market with their own brainpower. In his book, How Countries Go Broke, Dalio compares the AI revolution to the Industrial Revolution, stating that we are at the brink of a new era in which machine thinking will supplement or surpass human thinking in many ways. He says, and I quote, "The days of people making decisions in their own heads are ending." Think about that for a moment. The most successful hedge fund manager in history is telling us that the era of human-led investment is over, and he's putting his money where his mouth is. In October 2025, Dalio unveiled Digital Ray, an AI clone of himself, designed to share his investment philosophy with the world. His firm, Bridgewater, has been quietly reshaping its portfolio to capitalize on the AI boom. Dalio's message is clear: adapt or be left behind. He warns of exceptionally big differences in performance between those who use AI well and those who don't. It's a new form of natural selection, and the stakes are measured in billions of dollars. And it's not just Dalio. Every major player on Wall Street is in an all-out arms race to develop and deploy the most advanced AI. Let's take a look at the giants. First, BlackRock, the world's largest asset manager with over $10 trillion under management. That's more than the GDP of most countries. They've been using AI for nearly 2 decades. Their proprietary platform Aladdin, which is used to manage over $24 trillion in assets, is a technological marvel that increasingly incorporates AI. They have a tool called the thematic robot that uses LLMs to analyze vast amounts of data and identify investment themes. Their AI models are trained on over 400,000 earnings call transcripts from 17,000 companies going back 2 decades. They are not just following the market, they are trying to predict it, using AI to find patterns that no human could ever hope to see. Then there's JP Morgan Chase, the largest bank in the United States. Their CEO, Jamie Dimon, recently announced that their $2 billion annual investment in AI has already paid for itself. They are deploying agentic AI that can not only analyze but also act, handling complex multi-step tasks that were once the domain of human employees. They see AI as a way to drive the cost of expertise towards zero. Goldman Sachs, the legendary investment bank, is another AI pioneer. Their research shows that their AI-powered trading desks have seen a 27% increase in intraday profitability compared to human-only desks. They are using AI to execute trades at speeds that are almost instantaneous. In a recent report, they estimated that the stock market has already priced in $19 trillion of value related to AI. That's a number so large, it's hard to comprehend. It's more than the entire GDP of the United States. And let's not forget Citadel Securities, one of the world's largest market makers. They've been using machine learning for 20 years. Their global head of fixed income, Shyam Rajan, has said that they are now deploying AI selectively in areas where it measurably reduces friction and amplifies human judgment. They are in a constant race to be the fastest, and in the world of high-frequency trading where trades are executed in microseconds, AI is the ultimate weapon. Now, you might be thinking, okay, Boni, the big guys have the resources to build these incredible AI systems, but can AI really outperform the best human investors on a level playing field? Well, a recent study from the Stanford Graduate School of Business has given us a stunning answer, and the answer is a resounding yes. In June 2025, a team of researchers at Stanford published a paper that has sent shockwaves through the investment community. They created an AI analyst and had it make stock picks over a 30-year period from 1990 to 2020. The results were so unbelievable that the researchers themselves thought they had made a mistake. They spent a year trying to find a flaw in their model. They couldn't. Here's what they found. Over that 30-year period, the AI analyst, using only publicly available information, outperformed 93% of human mutual fund managers, and not just by a little bit. The AI's returns were on average 600% higher. Let me say that again, 600% higher. The human managers generated about $2.8 million in alpha, or benchmark-adjusted returns, per quarter. The AI generated an additional $17.1 million per quarter. On top of that, how did it do it? The AI was trained on market data from the 1980s, learning to correlate 170 different variables with future stock performance. It then took the actual portfolios of 3,300 mutual funds and once a quarter made small tweaks, swapping out underperforming stocks for ones it predicted would do better. It wasn't doing anything magical. It was simply better at processing information. As Professor Ed DeHaan, one of the study's authors, put it, it turns out this information is expensive to know, even when data sets themselves are freely available. The AI was able to overcome these information processing frictions that limit human analysts. This study is a watershed moment. It proves, in a rigorous academic setting, what many have long suspected, that in the game of investing, The human brain is now the underdog. Now, with great power comes great responsibility. And in the world of finance, with great power also comes great risk. The rise of AI in trading has regulators around the world very, very nervous, and for good reason. The International Monetary Fund, the IMF, has been studying this issue closely. In their October 2024 Global Financial Stability Report, they warned that while AI can make markets more efficient, it can also lead to higher trading volumes and greater volatility in times of stress. They point to the risk of flash crashes like the one in May 2010 when the stock market plunged and then recovered in a matter of minutes, driven by automated trading algorithms. The IMF's research on AI-driven ETFs, or exchange-traded funds, is particularly revealing. They found that these ETFs turn over their portfolios about once a month, compared to less than once a year for a typical actively managed ETF. That's a 12-fold increase in trading activity. The IMF warns that this could contribute to market instability, with the potential for herd-like selling during times of stress. Regulators like the SEC and the CFTC in the United States are grappling with how to oversee this new technology. They are concerned about market manipulation, where bad actors could use AI to spread false information and manipulate prices. They are also worried about the rise of non-bank financial intermediaries, like hedge funds and proprietary trading firms, which are less regulated than traditional banks and are leading the charge in AI adoption. This makes the market less transparent and harder to monitor. The proposed solutions include new volatility response mechanisms, like circuit breakers that can halt trading during extreme volatility, and stronger oversight of non-bank entities. But it's a cat-and-mouse game. The technology is evolving so quickly that regulators are struggling to keep up. It's a classic case of the law trying to catch up with technology. And in this race, technology has a significant head start. So, we've heard from the giants of finance and the regulators, but what about the people on the front lines, the developers and traders who are actually building and using these AI tools? For them, this is a time of incredible excitement and opportunity. The release of models like GPT-5 has been a game changer. Developers are now using these models to create trading bots and strategies with a level of sophistication that was previously unimaginable. They can use natural language to describe a trading strategy, and the AI will write the code for them. They can feed the AI vast amounts of market data, and it will identify patterns and suggest new strategies. Of course, it's not as simple as just asking the AI to make me rich. As any experienced developer will tell you, there's a lot of work involved in cleaning the data, training the model, and backtesting the strategy. But AI is a powerful tool that can amplify human intelligence and creativity. It's not about replacing the trader, but about giving the trader a superpower. And it's not just for the big institutions anymore. There are now a growing number of platforms and tools that are making AI-powered trading accessible to retail investors. While these tools may not be as powerful as the multi-billion-dollar systems used by hedge funds, they can still provide a significant edge. They can help you analyze the market, manage your risk, and execute trades more efficiently. Now, no discussion of the future of finance would be complete without talking about crypto. The cryptocurrency market is the Wild West of the financial world, known for its extreme volatility and rapid innovation, and it's a perfect playground for AI. As we saw earlier, the crypto market is currently in a state of extreme fear. Bitcoin is down, altcoins are bleeding, and liquidations are rampant. In this kind of environment, human emotions can be a trader's worst enemy. Fear can lead to panic selling, and greed can lead to reckless buying. AI, on the other hand, has no emotions. It can analyze the market objectively and execute trades based on pure data and logic. AI is being used in the crypto space in a variety of ways. There are AI-powered trading bots that can trade on your behalf 24/7. There are AI-powered sentiment analysis tools that can gauge the mood of the market by analyzing social media and news articles. There are even AI-driven crypto projects that are using artificial intelligence to build more efficient and secure decentralized applications. For example, some projects are using AI to optimize liquidity in decentralized exchanges, reducing slippage and improving the trading experience. Others are using AI to detect and prevent fraud and security breaches. The possibilities are endless. As the crypto market continues to mature, we can expect to see AI play an increasingly important role in every aspect of the ecosystem. So, what does this all mean for the future of trading and investing? Are we headed for a future where humans are completely obsolete, where our financial destinies are determined by a handful of all-powerful AI systems? Or is this the dawn of a new era of opportunity, where AI empowers us to make better decisions and achieve our financial goals? The truth, as always, is probably somewhere in the middle. The rise of AI in finance is a double-edged sword. It has the potential to make markets more efficient, to unlock new sources of alpha, and to democratize access to sophisticated investment strategies. But it also comes with significant risks, increased volatility, the potential for market manipulation, and the concentration of power in the hands of a few. One thing is for sure: the world of finance will never be the same. The skills that were once essential for a successful trader, a good gut feeling, a strong network of contacts, the ability to read a chart, are becoming less and less important. The skills of the future will be the ability to work with AI, to understand how these models work, to ask the right questions, and to interpret the results. For the individual investor, the message is not to be afraid, but to be prepared. Educate yourself about this new technology. Understand its capabilities and its limitations. And most importantly, never forget that even the most sophisticated AI is just a tool. It's a powerful tool, to be sure, but it's still a tool. And like any tool, it's only as good as the person who wields it. Thank you for joining me on this journey into the future of finance. I hope you found it as fascinating as I did. As always, I'd love to hear your thoughts in the comments below. What do you think about the rise of AI in trading? Are you excited or are you concerned? Let me know. Until next time, this is Boni for Boni's Life. Stay curious, stay informed, and stay ahead of the curve. Let me share with you some specific examples of how these AI systems are being deployed right now in real time across different asset classes and markets, because understanding the practical applications is crucial to grasping the magnitude of this transformation. In the equity markets, AI is revolutionizing everything from stock selection to portfolio optimization. Take Renaissance Technologies, the legendary quantitative hedge fund founded by mathematician James Simons. While they've been using mathematical models for decades, the integration of modern AI has taken their capabilities to an entirely new level. The Medallion Fund, which is only available to employees, has generated average annual returns of 66% before fees since 1988. That's not a typo. 66%. And while they don't publicly disclose their exact methods, industry insiders believe that machine learning and AI play an increasingly central role in their strategies. In the fixed income markets, AI is being used to predict interest rate movements, assess credit risk, and optimize bond portfolios. JP Morgan's LOXM system, for example, uses reinforcement learning to execute large bond trades with minimal market impact. The system learns from millions of past trades to determine the optimal way to break up a large order into smaller pieces, timing each execution to minimize slippage and transaction costs. The results have been remarkable, with the bank reporting significant improvements in execution quality compared to traditional methods. In the foreign exchange markets, which trade over $7 trillion per day, AI systems are analyzing everything from central bank statements to Twitter feeds to predict currency movements. These systems can process news in multiple languages simultaneously, detecting subtle shifts in sentiment that might signal a change in monetary policy or geopolitical risk. They can also identify arbitrage opportunities that exist for mere milliseconds, executing trades faster than any human could even perceive the opportunity. In the commodities markets, AI is being used to analyze satellite imagery, weather patterns, and shipping data to predict supply and demand for everything from oil to soybeans. Some hedge funds are using AI to count the number of oil tankers at sea or to estimate crop yields by analyzing satellite photos of farmland. This kind of alternative data analysis was simply impossible before the advent of modern AI. Now let's talk about the economist's perspective on all of this. Because while the traders and investors are focused on making money, the economists are asking bigger questions about what this means for market efficiency, price discovery, and financial stability. Professor Marcus Brunnermeier of Princeton University, one of the world's leading financial economists, has written extensively about the implications of AI for financial markets. He argues that while AI can make markets more efficient in normal times, it may actually increase the risk of systemic crises. The reason is what he calls model homogeneity. If everyone is using similar AI models, trained on similar data, they may all make the same decisions at the same time. This could lead to crowded trades and sudden, violent market movements when conditions change. Professor Andrew Lo of MIT, another giant in the field of financial economics, takes a slightly more optimistic view. He argues that AI represents a natural evolution in the adaptive markets hypothesis that he pioneered. In his view, markets are constantly evolving ecosystems, and AI is simply the latest adaptation. Those who can harness it effectively will thrive, while those who can't will be selected out. But he also warns that this process of adaptation could be painful, with significant disruption to traditional financial institutions and career paths. The Bank for International Settlements, often called the Central Bank of Central Banks, has also weighed in on this issue. In a recent report, they highlighted both the opportunities and the risks. On the opportunity side, they note that AI could reduce information asymmetries, improve risk management, and make financial services more accessible to underserved populations. On the risk side, they warn about the potential for AI to amplify market volatility, create new forms of systemic risk, and raise difficult questions about accountability and transparency. Let me also address a question that I know many of you are thinking. What about the ethical implications of all this? Should we be comfortable with algorithms making decisions that affect the retirement savings of millions of people? What happens when something goes wrong? These are not hypothetical questions. We've already seen examples of AI systems behaving in unexpected ways. In 2012, Knight Capital, a major market maker, lost $440 million in just 45 minutes due to a software glitch in their automated trading system. The company was nearly bankrupted and had to be rescued by a consortium of investors. More recently, there have been concerns about AI systems inadvertently engaging in market manipulation or being vulnerable to adversarial attacks where bad actors deliberately feed them misleading data. The question of transparency is particularly thorny. Many AI models, especially deep learning systems, are essentially black boxes. Even their creators can't always explain exactly why they make a particular decision. This raises serious questions for regulators. How do you audit a system that you can't fully understand? How do you hold someone accountable for a decision made by an algorithm? And some experts are calling for what they call explainable AI, or interpretable machine learning in finance. The idea is to develop AI systems that can not only make predictions, but also explain their reasoning in terms that humans can understand. This is an active area of research, but it's technically challenging. There's often a trade-off between performance and interpretability. The most accurate models tend to be the least explainable. Despite these challenges, the momentum behind AI in finance is unstoppable. The potential rewards are simply too great, and the competitive pressures too intense for anyone to sit on the sidelines. As Ray Dalio put it, this is a new form of natural selection. And in natural selection, there's no prize for second place. So, what should you, as an individual investor or trader, do in this new world? Let me offer some practical advice. First, educate yourself. You don't need to become a data scientist or machine learning expert, but you should understand the basics of how these systems work. There are excellent free resources available online, from courses on platforms like Coursera and edX to YouTube channels dedicated to explaining AI in accessible terms. The more you understand about the technology, the better equipped you'll be to evaluate AI-powered investment products and to avoid being taken in by hype or scams. Second, be skeptical. Not every product that claims to use AI actually does, and not every AI-powered product is actually effective. Ask tough questions. What data is the AI trained on? How has it been backtested? What are its limitations? Any legitimate provider should be able to answer these questions. If they can't, or if they're evasive, that's a red flag. Third, remember the fundamentals. AI is a tool, not a magic wand. The basic principles of investing still apply. Diversify your portfolio. Don't invest money you can't afford to lose. Be wary of anything that promises guaranteed returns or sounds too good to be true. AI can give you an edge, but it can't eliminate risk. Fourth, consider starting small. If you want to experiment with AI-powered trading tools, start with a small amount of capital that you're comfortable potentially losing. Treat it as a learning experience. See how the tools perform in different market conditions. Understand their strengths and weaknesses before committing significant resources. And finally, stay informed. This field is evolving incredibly rapidly. What's cutting edge today may be obsolete tomorrow. Follow reputable sources of financial news and analysis. Pay attention to what the big institutions are doing. Watch for regulatory developments. The more informed you are, the better positioned you'll be to adapt to whatever comes next. As we wrap up this deep dive into the AI revolution in finance, I want to leave you with one final thought. We are living through a moment of profound transformation. The financial system that has existed for centuries is being fundamentally reimagined. This is simultaneously exciting and unsettling. It's exciting because it opens up new possibilities, new opportunities, and potentially a more efficient and accessible financial system. It's unsettling because it means that the old rules no longer apply, and we're not yet sure what the new rules will be. But here's what I believe. The human element in finance is not going away. It's evolving. The most successful investors and traders of the future won't be those who try to compete with AI on its own terms. They'll be those who learn to work alongside AI, to leverage its strengths while compensating for its weaknesses. They'll be those who can ask the right questions, interpret the results critically, and make decisions that incorporate both data-driven insights and human judgment. The future of finance is not humans versus machines. It's humans and machines working together in ways we're only beginning to imagine. And that future is not some distant possibility. It's here, right now, unfolding before our eyes. So stay curious, stay engaged, and most importantly, stay adaptable. Because in this new world, the ability to learn and evolve may be the most valuable skill of all.